Now we're going to talk about the specific policies that are going to go along with a market-based approach to the macroeconomy. We have three in particular, starting with encouraging competition. Like we said in the previous video, this is very much akin to everything that we talked about in microeconomics. So essentially we're going to say that the market, if it's left on its own, will allocate resources in the best way possible. Let's see what that means in our macroeconomic objectives. If there's more competition, well, obviously there's one of the ways you get more customers is by lowering your price. So it says plus price, but I mean actually it's an advantage that price will go down for consumers. Another way I can get more customers is to offer better quality. So that's also an advantage for consumers. But keep in mind, we're talking about the macroeconomy, so it's everything. Well, if prices are going down, then that must mean that wages are going down as well, because one of the reasons that I'm able to charge a lower price is if I drop my input costs, and often that means that wages would have to drop as well. Now, if I'm able to drop my input costs solely because of better technology or something like that, that's a different matter, but it's unlikely, especially when we talk about number two. What encouraging competition can mean is, first of all, it can mean privatization. So, where there might be something that's provided by the government, maybe a big utility like water, what the government will do is stop providing water and instead sell off that capability to a few competitors. So, now we have 2 or 3 people producing it where there was only one, the government. That competition hopefully would drive the price down and improve quality. Part of that argument is that because the private industries want to make a profit, that they're going to find ways to do it more efficiently than the government would have on its own. The drawback of that, though, is one way to increase profit is to kind of cut back or to cut corners, and if that's happening, well, then that takes away from the positives of that. Secondly, we can deregulate. This means to get rid of government oversight. It could be government oversight in making sure that things are safe. It can be government oversight in making sure that things are clean. And some of those things are good, of course. Obviously, a lot of those things are good. But it's fair to say that there's a good amount of things that the government requires businesses to do that probably don't have the intended effect. So all they end up doing is making costs higher and keeping people from wanting to innovate. They maybe don't want to make a new product because it's going to be such a laborious project to actually get it off the ground. However, in that vein, in the 2000s, a lot of the financial problems that came through the 2000s and really culminated in the 2008 financial crisis were a result of financial deregulation. Basically, a lot of laws were changed and a lot of risk was put onto private parties. The government kind of withdrew and said, okay, well, if you guys mess up, it's on you. And a lot of that was in just financial derivatives. So regulations can be a good thing. You know, regulations such as seatbelts have to be installed on cars. Well, that's a good thing. Regulations such as, you know, you can't talk on your cell phone in the car. Those are good things. So remember, you know, like we talked about in the previous video, the free market is good at many things, but it does fail. So if you deregulate, if you take off, if the government looks over it less, well, it might be allowed to fail more, and that could be too painful. Third, in the provision of public goods, we can contract that out to private suppliers, which is to say that the government can say, all right, we want to build some new roads in an area, but we're not going to build them. Instead, we're going to contract it out to various road builders, and they're going to compete against each other for the lowest price, and we'll buy from the cheapest people. Too often, though, that opens the government up to accusations of favoritism or corruption and not really choosing the best supplier. They might break up monopolies to allow prices to come down, and they might allow more foreign competition. So they might allow, you know, lower tariffs and trade duties and things like that, so that domestic businesses have to compete with foreign businesses and therefore have to be more efficient if they're going to be able to effectively compete. The second general thing that's going to go into market-based supply-side policies are labor market reforms. And this is really where we hear about Reagan and Thatcher. So Reagan, most famously, the air traffic controllers went on strike, and he famously fired something like 16,000 of them and replaced them. Well, that obviously is going to make them really unhappy. Thatcher did similar things with the coal miners and broke up their unions in England. Those guys get a lot of critique, and perhaps deservedly so, but it is interesting to point out that in both the US and the UK, that the economies were pretty stagnant prior to Reagan and Thatcher and did pretty well after the fact. Does that justify a lot of the negatives that came from their policy? Probably not. But at the same time, you have to look and see that there was a lot of economic growth after their times. Friedman, who we talked about before, he's the guy who basically came up with the idea of the natural rate of unemployment. Well, he said the natural rate of unemployment exists only because there are these so-called labor market rigidities, which is to say that minimum wage laws, union power, we'll talk about this third one in a minute, that those things prevent the labor market from actually getting to equilibrium. Therefore, at equilibrium price, a certain amount of people are left without jobs. This third one, social safety nets, is talking about if you do lose your job, what sort of things are going to, catch you when you fall. So unemployment insurance, but then also maybe it's really hard to fire somebody or let somebody go in a certain country because of its laws. Well, if that's true, if it's going to be hard for me to fire you, maybe I won't hire you in the first place because I'm afraid that once you've got your job and you're no good, that I can't get rid of you, so maybe I just don't hire you in the first place. So, freeing up the labor market might allow the size of the NRU to shrink or ultimately go to zero, although that's probably pretty unlikely. Lastly, market-oriented supply-side policies are going to look to incentivize production. And typically what this means is tax cuts. If you produce, you get a tax cut, or we'll give you a tax cut in hope that you will produce more, and obviously that's going to move aggregate supply to the right. We see this in three different areas. First of all, we see it in personal income taxes. And this all comes off of this sketch over here, which is called the Laffer Curve. And funny story about the Laffer Curve, it's L-A-F-F-E-R, it's named after the guy who came up with it. It supposedly was originally drawn on a cocktail napkin, which many people would say you'd probably have to have a few cocktails before this made any sense to you or before it seemed like a good idea. But we'll leave that critique to another day. What the Laffer curve is getting at on the y-axis is tax revenue. So the higher and higher up you go, the higher the amount of revenue that the government collects. Along the x-axis is tax rate, and it's talking about personal income taxes. So at the far left is if you had zero income tax. Well, if you have zero income tax, well, the tax revenue is obviously going to be zero because 0% of anything is, well, zero. However, this is where, and most everybody agrees with the next point, this is where it's really interesting that if you raise tax rate all the way to 100%, then government revenue would also be zero. Because in a free market society or in a free society, if the government's going to take everything that I earn, well, then I'm not going to go to work. What's the point of going to work if I'm not going to earn anything? So this point there and that point there, they make a lot of sense. Where it becomes a little bit more controversial is where is everything in between. Let's say that we're at point A and you think, okay, we need to raise government revenue. Well, if we're looking at the yellow dashes, well, we could raise government revenue by cutting tax rates and we would go up. But if we were trying to raise government revenue by cutting tax rates, but really it was everything in purple that was true, I went with my Lakers colors here. Well, if I were to cut tax rates, then actually government revenue would fall. So that's the real problem, is that Laffer, the Reagan, for example, ascribed to his philosophies. The problem is that they thought that the Laffer curve was the dashed yellow line, but they cut taxes and tax revenue, instead of climbing, in fact fell. Imagine that. So what you ended up having was less and less tax revenue while the government was spending money on lots of other programs. So the cuts in personal tax incomes, this is especially going to happen in the top rates because that's where we see most people who are incentivized to produce more. So for example, if I own a business and I'm making $100,000 a year, maybe I don't have much of an incentive to expand my business or double my business, open a second store to double my business. Maybe I don't have much of an incentive there, because especially back when this was, when people were coming up with this, marginal tax rates had been up around like 90% or even 95% in the US. It was this really high marginal tax rate. So what do I want to double the amount of money I'm going to make if I'm going to pay 95% of that away in tax? So a lot of this philosophy is really geared towards the top incomes, the top tax rates. If this does work, what we would see is an increase to C, which is an aggregate demand, or a change to aggregate demand. But remember, it's a change to aggregate demand that is happening because people are supplying more. The second tax that might be cut are taxes to what are called capital gains. This is when I've invested in something and I've bought it and now I sell it for a profit. That exchange and the profit that I make on that exchange is referred to as a capital gain, and you have to pay tax on that. Likewise, people who keep their money in the bank and they make interest on their money in the bank or some other investment, the interest they make on that investment, they have to pay tax on that as well. So, to encourage more savings, what will happen is that these two taxes will be lowered. So, if those taxes are lowered, then people are more incentivized to do those, to save money and to invest. Therefore, people will save more, and if there's more money in the bank to be saved, then there's more money to be invested from the bank. But again, this is very controversial because you could have someone who makes all of their income from capital gains. People who buy and sell stock, that's pretty much what they make their money from, is what are known as capital gains. So someone who's investing as their full-time career, their capital gains taxes tend to be much lower than personal income taxes. So someone may only have to pay a capital gains tax of, say, 20%, where someone else who makes far less money is having to pay 25 or even 30%. And that obviously isn't going to sit real well with people, especially if you reduce what it is. Third, this is going to be more directly aimed at businesses, is just to cut the amount of taxes that businesses have to pay. These might be licenses, they might be permits and things like that, but it could also be profits on their, or taxes on their profits if they're a corporation. So if they cut these taxes, there's going to be more investment because businesses are saving money. All of these arguments are essentially aimed at that last point, which is, if we can lower costs for businesses, they'll be more incentivized to produce. Well, let's follow some logic through here. If a business cost goes down, there's a few outcomes that could happen. It could be that if my costs go down, that I also lower prices, so that's good for consumers. Okay. It could be that I keep prices the same, therefore my profit goes up. Or it could be a combination of those two things where I lower prices and my profit goes up. We don't have a problem with businesses making more profit, because if they make more profit, it could be that they take that money and they use it for research and development to, again, expand the level of aggregate supply, and that could be a good thing. Or they might use it to expand into other markets or build new stores or something like that, and that's a good thing too. This is a very complicated issue, and it's something that people have very passionate opinions about. It very much is a difference between how some people see economics, conservative economists, how they see it, and how more liberal economists see the economy. I challenge you to try to get a diverse amount of reading on both sides. Look for sides that are critical of market-based supply-side policies. Look for sides that are in favor of market-based supply-side policies. I try not to editorialize too much when I do these sorts of things, but I do think that it's one of those where probably the truth is somewhere in the middle. There's a lot of validity to what's being said here, but there's a lot of validity to the criticisms of what's going on here. If you have any comments, go ahead and leave them below.